Good morning and happy Sunday. I hope you're all doing well. Today I'm going to talk about three high yielding dividend stocks that you can buy on Monday to help with retirement. They all range anywhere from about 8.5% in yield all the way up to 13%. So if that sounds interesting to you, stick around for the video and we'll talk about the three that I'm going to discuss. Hello, my YouTube friends. My name is Adam Kahn, and I'm the Rational Investor. I hope you're all doing well. Today is Sunday, February 25th. Amazing how quickly the year's going by. I can't believe it. It's just like floors me. The older that I get, the faster it goes. So today I'm going to talk about three dividend stocks that I own. Now, this is not financial advice, which you guys all know. And before I even get into the three stocks, if you could do me a favor, hit the subscribe button, smash the like button. We all know that's how YouTube's algorithm works. I really appreciate the support, and it helps other people find the channel as well. So thank you for doing that. Now, again, this is not financial advice. You guys need to do your own research and seek out a financial advisor when making your financial decisions. These are just stocks that fit me as I'm getting closer to retirement. They make sense to go into higher yields and get that return to help pay for, bills and things in my life as I hope to get to that stage. Where you are in your life and the needs that you have, you need to find the things that fit you and not necessarily follow me. This is just the stuff that works for me, and I like to talk about it. And I know that some people find some value in it. So, stock number one, let's get into it. Omega Healthcare Investors. Ticker symbol is OHI. It's currently based on Friday's close, paying an 8.55% dividend. They get into the healthcare space by being a REIT with triple net leases for people who have skilled nursing facilities and assisted living homes. So I like the space. I don't really see that having trouble or going anywhere, and they've been doing it a long time. The only thing that I'd complain about with the company is they haven't raised their dividend since 2019, and they only raised it a penny since then. Now, based on what I've read, they do have plans to start trying to push that further in the future, but at least for now, they really haven't. So maybe it doesn't grow the way I would hope. The stock price has drifted up a little bit recently. The one thing I really do like is last year when things were really bad, it might have been 2 years ago, but I think it was last year. When everything looked really scary, they actually bought a large amount of their stock and bought back into it, which gave me comfort that no matter what the rhetoric is and no matter what they're kind of saying out there, they're putting their money into the company in a way that tells me that they see future growth. Like, why else would they be buying such a big amount of their stock? And they bought it at a pretty good price as well. I find when companies make a purchase like that, it really is an indication of what's going on. Otherwise, I think they would have held off and not done that and supported the stock. It's been around a really long time. It's made it through some big ups and big downs in the stock market. That's what kind of gives me comfort with it. And I also think nursing facilities and healthcare isn't anything that's going anywhere anytime soon. They have a bunch of facilities in the US as well as the UK, and I think they're a pretty well run operation. So that's one of the ones I like. It's the one that's going to have the smallest yield of the three I'm going to talk about today. And like I said, they're really good companies. Now, I have a bit of a Peter Lynch philosophy. I don't try to time the market too well. If I have money to invest, I put it in. I don't even really dollar cost average because my attitude is the longer your money is in the markets, the longer it can grow. So to sit and wait to time it over the next year or 2 years or 3 years delays when I'm putting my money in the market. I know it's at all-time highs. I know it looks scary. I know all those other things, but the reality is what's been found time and time again is timing the market doesn't tend to work. So the second stock I'm going to talk about today kind of rounds out my portfolio as well because it's in a sector that I don't really have anything in and I don't buy into these companies directly. So it's an ETF called Verus Infra Fund, and they invest in preferred stock. The ticker symbol is PFFA, and based on Friday's close, they're paying a 9.5% yield. What I really like about it is it pays monthly, which I find really nice. They own over 185 different preferred stocks, so they're spread out among a lot of them. I guess the risk is that it's all preferred stock, so you have some risk of those having trouble, and maybe if one does, maybe a bunch of them do. But I love the monthly dividend. I think they're pretty well managed. I don't see it as high risk. I think they use some leverage to get the return that they get, but I also think they keep it in reason of how they're investing. I actually looked at the different companies and they're invested in. There's going to be a lot of names you'd recognize, what SG, whatever it is. They also have some in Ford, and like I said, it's a whole bunch of companies you'd probably recognize, along with some that maybe you don't. But they currently pay a 16.5-cent dividend. You get that every month. It's super cool. You can do the math of like how much you want to make per month, because like most of us out there, we live on a monthly budget. So I kind of like that better than the quarterly dividends, even though it really shouldn't matter too much. One of the things that I do for quarterly dividends, if I actually want to use the income, is I'll try to have enough cash in an account to cover maybe 2 quarters dividends, and then I'm still comfortable withdrawing it, doing the math and dividing it by three and withdrawing the proper amount every month, so that I know by the time it comes in, I'll have used up what I need to. And the reason I do 2 quarters instead of one is just in case something happens where they need to cut the dividend, that I've already covered a little bit extra and can make the decision of what I want to do from there. So anyway, PFFA, I think it's a great company. It gets me into preferred stock, which I don't typically buy directly. Um, and my guess is, since they're managed now, the one thing I don't like about the company is they have a pretty high expense ratio. It's like 1.4% is what they're charging, and zero point 0.8 of it is their management fee. It's pretty high for fees. At the same time, I figure it's worth paying the 1.4% because they're doing something that I don't have the time to research separately from all the other things I research on top of it. So hopefully I'm paying them properly to do a good job of what they're doing. And at least for the time I've owned it, which has been, I'm going on a good 3 years or something, they've paid that dividend every month, and I've been really happy with it. So the third stock in the high yielding stocks that I'm going to talk about is definitely not least, and it's probably my favorite, which is NextEra Energy Partners. Ticker symbol is NEP. I know you guys have seen me talk about it in a lot of other videos. It dropped from like $80 a share to 20 because it deals with solar and wind, and they also have some issues that came up that scared the markets. From what I look at in terms of a chart, it naturally fell from like 80 to low to mid 40s, which is where I think is probably fair value. They then made an announcement that they're not going to be able to raise their dividend as quickly as they expected, which were estimating to be able to raise it between 12 and 15% year over year going forward until 2026. They've lowered that guidance from to 5 to 8%, which is a good drop, and that caused the stock to drop from like mid 40s all the way down to 20, which, at least in my opinion, that was a bit of an overreaction. When it fell into the low 20s, that created a yield that it's now paying almost 13%. And at one point, it got as high as almost 15% that it was paying in yield when it was at the lows. Now, they've already reported 2 quarters earnings since they've announced that, and they've stayed in line with exactly what they've said. They've been able to raise the dividend at both of the last earnings reports, and they've given good guidance. So it makes me feel more comfortable that the information is accurate. Now, anytime that a stock falls as far as it did, it always makes me nervous that maybe something else is going on. And it's possible that in time they have some solvency issues because they do have a decent amount of debt. But to be fair, the debt, at least currently, is very manageable. It's not something I see as an issue of anything that's going to be a problem in the next year or two. Maybe in time it'll become a bigger problem, but they just sold their gas lines to Kinder Morgan that was able to shave off a lot of that debt. On top of it, the profits that they come in cover enough of the payments that they should be able to eat at it as well. Everything looks good. I'm just trying to point out some of the risk out there on it as well, because everything has some risk. What NextEra Energy Partners does is they do long-term contracts with NextEra Energy, which is their sister company, or however you want to think of it. and then they get paid based on that. The interesting thing is they actually have no employees because the employees are from NextEra Energy that kind of set up these contracts for the affiliate part that has the dividend paying part of the companies. Now, I know NextEra Energy has a dividend, but it's not nearly the size of what NextEra Energy Partners is, and I think they're both great companies. They're really trying to push for renewable energy to drive the world's use of electricity. And I think that's a great space to be in. Getting away from coal and the things that dirty our environment to going to solar and wind. And they're able to do it in a way that they're able to grow profits and really push the limits. And from what I've seen, in a great way. I think it's a good space and I want to be in it. And I like both of the companies. The one I'm talking about now is NextEra Energy Partners because we're talking about dividend yield. But I do like NextEra Energy as well. I think it's a great company, and I own some of it as well. So anyway, those are the three stocks. They push to try to drive dividends as I get older and as I want that is to be a bigger part of my portfolio. The primary part still is growth, but I really am trying to start shifting into those other things. Now, keep in mind, the reality is you want to invest whatever does the best. Some people get overly focused on the dividends, and sometimes myself included. But you're better off with whatever does better. I mean, quite honestly, would I have rather own Nvidia or would I rather own one of these because of the dividend? Well, of course, I would have rather own Nvidia. You get the profits, you can sell some of it if you need to, and move on from there. Anyway, I hope your Sunday's going well. I hope you had a nice weekend. Do me a favor, let me know if you have any high yielding stocks that you think I missed. I know there's a ton out there. I tried to pick three that nobody really talks about. That's why I picked these. I know the ones that everybody talks about, and I can tell you, me personally, I am not a fan of JEPI, JEPQ. I am sure not a fan of the yield max funds. I do not like TSLY or any of those others. I don't like that call covering strategy because I find it limits your upside. And if I want to own those companies or what the underlying is, I want to own those underlying. I don't want to simply sell calls against it. Anything I do want to sell calls against, I'd rather manage myself. Anyway, that's just my thought on those companies because I know a lot of people might make comments on that. Feel free to tell me that I'm wrong and I'm an idiot and why you like them if you like them. But I'm just not a fan of those in terms of the high yield stuff. I like the ones I've picked, and I'm sure you guys might be able to point out some others I'm unaware of. Anyway, again, thumbs up, hit that subscribe button, do me a favor, share it with your friends, and make some comments. Have a great day.